rules of thumb are really good for direction, but they're not good based on our facts and circumstances. So there's two rule of thumbs, there's a couple of rule of thumbs here that I'm going to get into. And the one now under our current law, our old law, 2017, is that once you reach a certain threshold of earnings, you should become an S corp. S corps are king, just like depreciation. S corps are the best. So we'll address why they may not still be the best. And now the new idea is that C corporations are the best because of the new tax law rates on there, and I'm going to get into that, show you some examples. There's the flip side is that C corps really aren't applicable to anybody that under the old law. They're barely applicable to anybody, and everybody in here, there's probably only 3 or 4 people that actually have C corps, but now we actually have to consider them as a legitimate option. But I'll get into that in more detail. And the other rule of thumb is no real estate in a corporation. I'd say that one sticks. Everything that I've read so far says that one's going to stick. So some rule of thumbs, they're very applicable, but your facts and circumstances are going to dictate what's right for you. So, like I said, major tax reform happened with your business side. And so we have the C corporation, the S corporation, the partnership, and the sole proprietorship. So the C corp is a standalone entity that pays its own tax. The S corp, partnership, and sole proprietorship, you pay the tax on your side. So most of you in this room and online are going to be in that pass-through entity side. So I'm going to address each of these different areas, and if I refer to something as pass-through, and you know that, hey, I'm an S corp, or hey, I'm a partnership, or I'm a Schedule C, sole proprietorship is Schedule C. I'm going to refer to those as pass-through, so forgive me on the terminology that I may use here. So, like I said, we're living in that pumpkin period where rates are going to change in 2026. However, corporate tax rates actually were one part of the bill that became permanent. This is the most important part of the law change to Congress that need to be put in place. So corporate rates are actually one thing that's not going to change based on their definition of permanent in the tax law. But so on the left we have the old tax law, and we see we had progressive tax rates, although in the middle we had a higher tax rate than we did at the bottom. Under the new law, if you earn $1 or you earn $100 million, you're taxed at 21%. It's a flat tax rate for absolutely everybody. So this new law really makes it look really well for really two cohorts, and that's somebody that's in that individual tax bracket that's in the 22% or higher. They should start considering it, and then the other one is for a new business that's starting up, and they pretend you're a doctor, you go into practice, and your plan is to sell in 5 to 10 years. And a C Corp could be the winner because when you start a C Corp, there's this qualified small business stock rule that allows you to sell your stock at everybody's favorite tax rate, 0%. So if you have your facts and circumstances are, hey, I'm going to start this business, and I plan on, this is my progression through, the next 5 to 10 years. I anticipate, and I plan on selling at that point. This 21% corporate rate and that 0% qualified small business stock, that becomes very powerful. So if you're in that ballpark and know somebody, that's where they need to definitely start considering it. But you guys are thinking that's great, but some of you that do have C Corp probably fall in that 15% rate. So if we go to the corporate tax rate slide, there's a lot of people that had C Corps try to stay in the 15% rate. Well, now you're actually getting a 6% increase on your tax rate for that same money. So the math is going to be a little harder and whether or not it's a good benefit for you. It still could be phenomenal because there's other reasons to be a C Corp in these tax rates. There's different benefits, and qualified small business stock is another reason. What you need to really reevaluate, because if you're in that 15% bracket before, if you run some math, I don't know if you're going to still benefit from it. So the next slide, that's great, but I have one of those pass-through entities you mentioned before, and 37% is a lot higher than 21%. I get it, and that's why that rule of thumb idea that everybody is going to become a C Corp, well, that's where they introduced this new law. You go to the next slide, qualified business income. So you're going to love qualified business income, and you're going to hate it. You're going to love it because it will reduce your tax for many situations. You're going to hate it because this is complicated. And the more you make, the more complicated it is. And we're going to get into that. So C Corps, they have their flat 21% rate. You pass-throughs, you S Corp partnerships, Schedule C, Schedule E's. This applies to rental real estate too. You are all going to have this qualified business income, and this is where the fun happens, I guess. So this next slide, the income thresholds and QBI. So qualified business income is QBI, and I'm going to call it QBI going forward. And this slide might be the most important slide in the whole slide deck. And this is the most complicated slide because it gives us that base level that we need to understand. So there's a service business and a non-service business, and they are going to be different rules for those types of business. So the service business, that is the attorney, the financial advisor, the real estate agent, doctor, accountant, and consultant. So this is going to be a very big definition. I think there's going to be probably a lot of court cases on who falls under consultant because consultant's fairly broad. Then brokers, like real estate brokers, are probably going to fall in here. So this is going to be a big area. So this examples of a service business is not the all-inclusive, but it gives you a good idea of who that is. And if you fall into that category, we're going to look at the service business column. And everybody who is not a service business, then you're probably not service. So non-service to me is certain franchises like a gym, a McDonald's, a Hardee's, a Subway, software developers, something like that. I think that's some of those ideas, manufacturers, obviously. I think that's a much broader category. They have more favorable rules. And the reason they're more favorable because the idea is they hire more people and they create a product that increases more, adds more value to the economy. As a service business, really you're providing service and earning wage income just indirectly from trading services between other people. So that's a general definition, but let's look at this first row here. So there's taxable income less than $315,000. So that's for married filing jointly. If you're single, split it in half. Just split it all in half, and anybody that earns under $315,000 will get this 20% deduction. So $315,000 means not just your business income. It means if you're married and your spouse is a W-2 employee, then say they earn $315,000 and your business has $10,000. Well, you're actually over $315,000 of taxable income, in a way. So therefore, we need to understand taxable income for your family or yourself, not just your business income. However, the calculation is on 20% of your business income. We'll get into illustrations of this. So the 20% deduction, this is where you're going to love it. If you fall in this category, it's very powerful, and you're going to see that by the end. So now if your taxable income is between $315,000 and $415,000, it starts to phase out. This 20% benefit starts to go away. And once you reach $415,000, if you're a service business, there's no more deduction. All the fun is over. And but if you are a non-service business, then there are these two new considerations. So that's 50% of W-2 wages, 25% of W-2 wages plus unadjusted basis. So this 2.5% of unadjusted basis, this is for the real estate investors, real estate entrepreneurs. So real estate, you are in this non-service column. Property management, right now I think you're going to fall in the service business. That's something that I'm going to look into more. But property management portion of the business probably going to fall in the service, but your real estate investments are going to fall in this non-service. So when we calculate this deduction, we're actually going to look at it on an entity by entity basis. So if you have your main business and then the real estate that it's on, there's going to be two separate calculations for that, because you have your non-service business and your service business. And we'll get into examples of that, but this is going to be an entity by entity calculation. So the next slide. So right here is just a snapshot of your tax return. So QBI versus taxable income. So I said qualified business income is the profit of your business. Taxable income, so if you go back one slide, income threshold and QBI, we're talking this $315,000 number, or put that in half for single. So that is not the same as your business. So your business is line 12, your line 17 and 18, and your taxable income is line 43 under the current form. We don't know what the new forms are going to look like, because they change other things too, but this is what it's going to look like, and we're going to calculate your QBI deduction from this line 12, 17, and 18, but how much of that you receive for a benefit, which could be range between 0 and 20% of your QBI, will be dictated by this line here. So this is what I mean that if you, so pretend you're a partner in a law firm, and you're single and your other partner is married, and you both receive $200,000 from the law office. So you both calculate your QBI on that $200,000. So you get your $40,000 QBI deduction, but your partner is married to a doctor who makes $500,000. They're going to be, all of a sudden now that partner's taxable income is higher than this other partner's taxable income, so they're going to have a different QBI benefit. So when you make these decisions going forward, you're going to have to consider not just you individually, how it's impacted, but the other partners, because you might be like, hey, we need to go to a C Corp or an S Corp or factory Schedule C or something. The other partner may be like, no, we need to do this, because they have different factors. So that's why it's complicated, and going to be a huge discussion point, and we have a ton of examples going forward to help grasp that a little bit better. So earlier I talked about rules of thumb, and I said everybody wants to be an S Corp once they make a certain profit level. So on this slide I have a sole proprietorship versus partnership versus S corporation. So on the left I have the consultant or franchise owner that earns under $315,000. So they're, you know, in the old school way, we'd say you need to be an S corporation. It's a fact, because you're going to receive a big discount on your self-employment tax. So if you look at the spreadsheet, we have SE tax line here. Yes, you're going to save about $5,000 in SE tax. But qualified business income deduction is calculated based on the profit of the business, not your salary. So because you're an S corporation, you have to take a salary. Now your QBI deduction is a lot less. So if you look here, the sole proprietor versus the S corporation, there's a pretty reasonable gap of $30,000 that the QBI deduction is less. So if we go down a little further to the income tax line, you see all of a sudden your income tax is $7,000 higher. So in this scenario, your rule of thumb that everybody needs to be an S corp, it just got, to be an S corp, it's going to cost you $2,000 more per year to be an S corp in this scenario. So this is one of those where to make it work, you may have to change your facts if possible. And I mean, it's a big game over that it's automatic win. However, in the same example, we have somebody earning $415,000 because they have different rules for that. And I have, you see here, I have a franchise owner, software developer. So this is somebody that's not a service business. I know franchises can be a service business, but assume it's not a service business here. They're over $415,000 in taxable income. And in this scenario, they're actually going to save $30,000 per year in tax by being an S corp compared to the others, because the 50% of W-2 wages is factors in, because there's no QBI deduction for the sole proprietorship or the partnership, because you take the lesser of this wage or this 20% of QBI. told you it's complicated. And so your facts and circumstances are going to matter. So how much do I pay myself matters, and we'll get into that too. So here's this slide is just to show that the old rule of thumb is over, but S Corp is still a powerful, powerful entity. So now the other thing was the pass-through, being a pass-through entity versus being a C corporation. So I'm on to the next slide here. And so the D now is we have 20% rate. We're like, hey, we should be a C corp because that's automatic winner for me. So the calculation is we have a 21% tax on the entity here. That's TI entity. That's the taxable income for there because you have to pay yourself a salary, and that's the deduction for the business. If you jump down to TI for entity line here, that's at 21% tax. But as a corporation, you have to pay double tax. You pay tax at the entity level, and you get to pay tax when you take money out. So you have to take money out in two ways. You take it out as a salary, so that's that $127,200 there, or you take it out in the form of a dividend. Well, as an S corporation or a partnership, you're used to taking out dividends, and they're taxed at your favorite tax rate is 0%. But on a C corporation, you're taxed at your actual capital gains tax rate. So that when we add all this together, a C corp for this individual, this franchise owner or consultant, being a C corp, it's a $30,000 higher tax because they want to take out all the money they can from the business, and you're paying $30,000 more per year to be a C corp. So the rule of thumb that a C corp is the automatic winner? No. There's definitely your facts and circumstances that could say this is a winner, and we'll show some examples where it can be a winner. But this isn't, you can't default to changing your entity right away. So now I'm to the next slide, a different strategy, different results. So this is that, so now I have a financial advisor. I have them in two scenarios here. So I have the financial advisor that earns over $415,000 because being over 415 is where all the different exceptions apply. So in this, I'm comparing the Schedule C or partnership versus 11 S Corp and a C Corp. In this scenario, the C Corp actually costs $20,000 more per year in tax because they want to take out all the money they can from the business. So that's where this TI after QBI dash DIV, that line, that's $363,000. So they want to take out all the money from the business. And so that's why their tax is higher. But however, what if they want to not take out as much cash from the business? So if you go over to the right side, and they only take out $181,000, now all of a sudden their total tax is less by $6,000 to the partnership for Schedule C. It's a little bit more than the S Corp, but that could still be beneficial, and that's why your facts and circumstances are what you're going to do. If you're going to leave money in the business, then this is a scenario where the C Corp becomes more powerful. So really, it becomes this big math equation of what entity should I be, and what is my plan going forward. There's just nothing automatic under these new rules. So now this next slide. So this is for a real estate investor, and to keep these examples simple, I pretend that the only income is only from the business. I'm not considering income from the spouse or a W-2 employee outside, because otherwise this is too complicated. I don't want to bore you any more than this. So now I have a real estate investor that earns over $415,000, and they have two properties. One property, and say they're identical properties, they just own them in different entities. Property one, they have all the debt. I have no debt in property one, but they have all the debt in property two. In our old law, 2017, nobody really cared because it all was flowed to the same line, and you had $680,000 of taxable income in this scenario. Under the old law, nobody cared, but under the new law, we have to calculate how this unadjusted basis versus QBI works. And if you see a 20% of QBI versus a 2.5 unadjusted basis, remember I said these two properties are identical for our theoretical example here. They have the exact same unadjusted basis, but their QBI is different. So you take the lesser of those two. So your total QBI for these two properties is 125. Now let's say we take the debt and we make them equal. We split the debt between two entities. equally. So now all of a sudden our profit's the same between two entities because we have the same debt structure. So now we take the lesser of the QBI, or the unadjusted basis, and we get $136,000 QBI. So by literally taking debt and splitting it evenly between two entities, you are going to save yourself $3,800 per year. Think about that differently. If you don't split them evenly, it's going to cost you $3,800 more per year for just not splitting where your debt is. This is something we never even had to consider before, but now it matters where your debt's located because it impacts the profit of each entity. So now the next slide. So let's say you're a service business between $315,000 and $415,000. So I have an attorney here that's in that range. So when you're in that range, remember there's a phase out period starts, and that's $100,000 of difference of your salary. Or your, I said salary, but that's actually a typo. That's just your profit from your business. Your profit from your business, there's a $100,000 difference. When you're under the 315, you get this 20% QBI deduction. Once you hit 415, you get a $0 QBI deduction. So that $100,000 is going to cost you $39,000 in tax, which is a 39% tax rate. But if you look to the right here, your tax rate should really only be 32%. So planning within this range is going to be huge. There's permanent tax savings in there, and it really needs to be watched. So this is where maybe deferring more to a different type of retirement account, a defined benefit plan. Like pretend this is a chiropractor, and they change this example from attorney to chiropractor and say they're in this range, but they also sell like holistic products inside their business, and they do their medical work. So they have the service business, the medical work, but they also sell these products, which is non-service. You're going to want to break those out because you want that non-service business to get that deduction, because when you're a service business, you don't receive it. That was probably a little hard to visualize, but you're going to have to have different strategies once you fall into this range if you're a service business for sure. All the non-service businesses with franchise owners, software developers, you're going to have a different calculation. We showed those before. But non-service or service businesses, this is a big area of planning that you're going to have to focus on. So go to the next slide. And online participants, I apologize, I added these late. And you can get them, you just send me an email if you'd like to get these last two slides. So the raising your salary. So pretend you're an S-Corp owner and you're paying yourself $127,000. And the way you're over $415,000, and all of a sudden your QBI deduction becomes the 50% of wages because you're the sole owner in the business. Your total tax comes with $121,000 when we run the math. But what if you gave yourself a $15,000 bonus, paid yourself more salary, which sounds crazy because all you're doing is shifting it from business income to your W-2. All of a sudden, the way this calculation works is you're saving $3,000 in total tax. And all you did was just shift the buckets of where it's at. So this 20% of QBI, this 50% of W-2 wage, you're going to want these to be pretty similar. You're going to, assuming you have the opportunity to make them similar, it's going to be very powerful for that. Keeping your tax rate down, because this is just paying yourself a smart wage, saves you $3,000. Last slide is really, like I said, we're in this pumpkin period of maybe it's a golden opportunity. And here's an example of somebody that earns $315,000 or less. I use exactly $315,000. Pretend you had taxable income of $315,000 in 2017, and now you have it in 2018. So if you did it as a W-2, that's the far right column, your marginal tax rate will be 24%. And just from being a W-2 employee between 17 and 18, you're going to save almost $15,000 in tax, just inherent of how the tax law is. But if you're a business owner, all of a sudden you're going to be paying $30,000 less in tax, which increases your cash flow by that. So your margin rate becomes 19%. So it's just incredible these built-in tax savings opportunities that are here, but it also changes the way you need to think about some of your different strategies. Because you're probably used to maximizing your 401k, deferring it to future years, because you're in a higher bracket now than you will be later. If you're at a margin rate of 19% for this money, should you, I mean, is a Roth more favorable for you now? I mean, you have to really change the way you think about it. And now you have this extra cash flow. Are you reinvesting it into your business? Are you how are you going to plan for that? There's just a lot of different things to consider and really to maximize your wealth effectively with these new rules and take advantage of making this qualified business income work in your favor. So now you're probably wondering, where do I go from here? What do I need to do? So this is honestly, you just need to map out what your QBI deductions are going to be. Because if you're projected to pay $30,000 less in tax in 2018, maybe you can start investing that money now because you don't have it earmarked for future years or the next year. And then after you map out your QBI deductions, you need to identify opportunities. Do I need to be a C Corp or an S Corp? Should I go back to being a Schedule C or become a partnership? A lot of these decisions you can wait and see how the year plays out, but to not be an S Corp anymore, you have to do that by March 15th. So there is time of the essence for that type of decision. And then, do I need to pay myself more of a wage? Do I need to reallocate where my debt's located? So the unadjusted basis, I didn't really touch on that, but let me do that for the real estate investors here. That unadjusted basis means the value of your property when you purchase it, and it's the life of the property. So if you have a commercial building in 39 years, so you have 39 years of unadjusted basis, but then it's adjusted for starting in 2018. And so if you bought in 2008 and in 2018 you'd have 29 years left of unadjusted basis. And if you bought so the personal property components of that, that's the your fixtures or whatever. Those actually use a 10-year life, so even though it's depreciated at 7 years. So this unadjusted basis is going to actually play an impact, but I didn't get into that because it's more complicated and hard to visualize. So tax deferral, if you're in that 315 to 415 range, like I said, tax deferral becomes permanent tax savings for many of you because you're not even going to be at 39%. I mean, the current law is not even at 39%. And if when you retire, you may not be in a top tax bracket either. So tax deferral is a new, more relevant consideration. So overall, just put your plan into place, stop overpaying taxes, focus on your wealth. We can look at this slide. If you're going to be increasing your cash flow by this significant amount of money, that is really the golden opportunity to help build your wealth. So that's all I had for slides. We're here for questions. Helen and Dave are also here for questions. You can either ask now. If you're online, you may need to unmute yourself to ask the question. Otherwise, you could type them into the box and Shannon can read it off. I heard a confusion comment. Yes, it is. And this new QBI is just, it is a beast. It is a lot. You just have to think about it differently now. There's some built-in savings, but getting your QBI right is going to be a little legwork there. Yeah, so it's simplified on the individual side, far from it. So they changed the alternate minimum tax. They increased the exemption for it, and the way alternate minimum tax works is you typically fell into when you had high real estate taxes and state income taxes. Remember those benefits are capped at $10,000? I'm having a hard time visualizing who's going to be impacted by alternate minimum tax, so it's going to be very interesting how those numbers fall into place. But from everything that I've read and understand, I don't think many people are going to be touched by alternate minimum tax as much. That's a good note to consider because this slide, the golden opportunity, is very simplified example. It doesn't take into account everything that could be involved. But yeah, just to give a good illustration of how it works. So, minimum tax is not considered tax. Their number would stay the same, so the withholding allowance would go down, and so they'll get a raise in their paycheck. Well, it'll be a different amount, but the number should. Yeah, the number would 12. So they picked 1 on their W4. There's nothing else. I got to thanks again for taking time out of your day. Be here afterwards.